Why would a billionaire investor pour over $1 billion into a company that's struggling? Bill Ackman's billion-dollar gamble on Nike could be the comeback story of the decade. Let's uncover why. Bill Ackman, one of the most well-known hedge fund managers in the world, has recently made headlines by placing a massive bet on Nike. After a period of market uncertainty, Ackman has gone all in, increasing his stake in Nike by 435% in just 1 quarter. This brings his total investment in the company to a staggering $1.4 billion. The question is, why now? What does Ackman see in Nike that others don't? Nike is currently struggling, and the market seems to think the worst is still ahead. The brand's stock is down 20% since mid-2024, and they've reported declining revenues with major challenges in key markets like China. But despite the turmoil, Ackman is making a bold move. Today, we'll explore why he's betting on Nike, why he believes this brand can bounce back, and what you need to know about Nike's current situation. Nike's struggles, a brand facing serious challenges. Nike, one of the world's biggest brands, is in serious trouble. Revenue's down, sales are slumping, and competition is fierce. Is this the end of Nike's dominance or just the beginning of a new chapter? Nike has been facing several serious issues over the past year. In the latest first quarter of fiscal year 2025 earnings report, Nike's total revenue fell by 10% on a reported basis, with similar declines across its major geographies. This drop was primarily driven by lower unit sales, a major 20% decline in Nike Digital, and supply challenges. Notably, its North American revenue declined 11%, and the highly strategic market of Greater China saw a 3% revenue drop. The company has faced challenges on multiple fronts. Economic turbulence, particularly in China, has severely affected consumer demand. Traffic and sales in China have been softer than expected, contributing to the revenue drop. Additionally, brands like Adidas, On Holding, and Deckers Hoka are challenging Nike in segments where they once had a firm grip, which has further hurt Nike's overall performance. Nike's inventory levels have also been a significant hurdle. The company reported elevated inventory, particularly in Greater China. As of the first quarter of fiscal year 2025, inventory levels were impacting sell-through rates and leading to markdowns, which further weighed on Nike's profitability. Despite these issues, the brand remains the market leader in China, but has acknowledged that the competition, both global and local, is stronger than ever. Furthermore, while revenue from Nike Direct was down 12% overall, there was a 20% decline in digital sales, largely due to the classic franchises underperforming on Nike Digital compared to the wholesale channel. Valuation and stock price decline. Nike's stock has seen a significant decline, dropping by approximately 37% since 2020, which has made the valuation multiples more reasonable compared to previous years. Currently, Nike is trading at the lowest valuation multiples in the last decade, with a price to earnings PE ratio of 22 and price to free cash flow P over FCF of 16. This indicates that the stock might now be more attractively valued compared to the past, especially considering Nike's wide economic moat. Inflation reportedly being under control also benefits consumer spending, and Nike's valuation is now at its most attractive level in 3 years. Combined with a change in leadership, this situation presents a potential opportunity for investors looking for value in the consumer sector. Shift to direct-to-consumer, a bumpy road. Nike's radical decision to cut off its retail partners is either a genius long-term strategy or a colossal mistake. Why is this shift so crucial to their future success, and why has it been so painful? Nike wants more sales through its own website and stores rather than relying on big retail partners. In theory, this approach could result in higher profitability and a better brand experience for consumers, but it's not without its challenges. The shift hasn't been smooth. As Nike reduces the inventory for classic franchises like Air Force One, Air Jordan 1, and Dunk, digital sales have plunged nearly 50% year over year. Wholesale partnerships have faced strains with inventory shortages in big retail stores during the transition, resulting in disappointing wholesale revenues. However, it's not all bad news. Despite the revenue decline, Nike has managed to expand its gross margins by 120 basis points to 45.4% in the first quarter of fiscal year 2025. This was achieved by streamlining warehousing costs and implementing strategic pricing. Nike is also pushing innovative new products like the Pegasus 41 and expanding into categories like trail running, moves designed to bring a fresh wave of consumer excitement. New leadership and strategic initiatives. The recent CEO transition to Elliott Hill brings potential strategic changes that could lead to improved growth. The company has withdrawn its previous fiscal year 25 guidance, but management is optimistic about improved revenue trends in the second half of fiscal year 25 due to new innovations and initiatives in performance sports. Nike's management is also focusing on performance sports innovation and expanding their brand narrative, which could provide future growth stability. They are scaling new innovations and expanding partnerships, aiming to drive superior brand storytelling and enhance their market position. Bill Ackman's strategy, a high conviction bet on Nike, a massive investment at the perfect time. With Nike's stock crashing, Bill Ackman has invested over $1 billion in just one quarter. Is he catching a falling knife, or has he found the perfect buying opportunity? Let's find out. At the time of his initial Nike investment, Bill Ackman's portfolio was also positioned with significant stakes in other prominent companies. Pershing Square, the name of Ackman's investment fund, had a notable position in Chipotle Mexican Grill, a company Ackman had supported for years, helping to drive a turnaround and subsequent stock price increase. Ackman also held a considerable investment in Alphabet, Google's parent company, though he had recently reduced his stake as part of a broader portfolio adjustment. This reduction in Alphabet and Chipotle was likely aimed at reallocating funds into what Ackman saw as more immediate opportunities like Nike. This broader context of Ackman's portfolio highlights his willingness to adapt his holdings based on market opportunities while staying true to his focus on large, influential brands. Ackman initially bought 3 million shares of Nike in the second quarter of 2024. This was already a significant investment, showing confidence in the brand. But after Nike's disappointing Q4 fiscal year 2024 earnings and a stock dip, Ackman saw a major buying opportunity. In the third quarter of 2024, he added 13.2 million shares, pushing his total Nike investment to $1.4 billion. The brand strength and cultural relevance. Nike is more than a brand. It's a cultural icon, but can that cultural power be enough to overcome their financial struggles? Ackman thinks so, and here's why. Ackman's move shows that he sees the inherent value in Nike's brand. Despite the struggles in revenue and competition, Nike is still one of the most recognizable brands globally. It has a deep cultural relevance that spans generations, and it has maintained its premium pricing power even during economic uncertainties. Ackman believes that this brand power is something competitors cannot replicate and that it will ultimately drive Nike back to strong profitability. And in the eyes of a value investor like Ackman, Nike's brand strength, iconic status, and current valuation present a unique opportunity. Analysts predict Nike's bottom line could grow at a compound annual growth rate of 9.09% over the next decade, supported by market share gains and share buybacks. Nike's valuation has hit a 10-year low, and it has investors like Ackman drooling over the potential. Are the signs pointing to a bargain buy or a company on the brink of failure? Nike's price to sales ratio is hovering around 2.3, which is near its 10-year low. Despite recent issues, Ackman sees this as a classic value investing opportunity. In his eyes, the market is overreacting to short-term problems while ignoring Nike's long-term prospects. Nike's shift to direct-to-consumer, a strategic long-term play. Nike's bet on direct-to-consumer could redefine how sportswear is sold. It's risky, it's messy, and it's exactly what Ackman thinks could make Nike unstoppable in the years to come. There's no denying that Nike faces a tough road ahead, inventory issues, a challenging Chinese market, and overall softer consumer demand, but Ackman is playing the long game. He believes that Nike's brand power, focus on sport, and ability to tap into the growing health trend will ultimately overcome the current setbacks. This bold investment showcases Ackman's belief in Nike's potential to bounce back and become even stronger. The question remains, will this be Bill Ackman's greatest comeback story? He certainly thinks so, and he's putting $1.4 billion on the line to prove it. We'd love to hear your thoughts. Do you think Bill Ackman has timed it perfectly, or is this a risky bet on a declining giant? Let us know in the comments below. Don't forget to like this video, subscribe, and click the bell icon so you don't miss any of our future updates on big market moves.